Okay, today in 23-2, we're going to talk about how to do the distribution of net income on our owner's equity statements, as well as the distribution of income on our net income statement, both for our partnerships. So, the partnership's net income or net loss can be divided any way that is agreed upon by the partners in their partnership agreement. It's one of the reasons why having a partnership agreement, which we learned in the last lesson, is so important. That way, there aren't any squabbles or arguments over who gets how much. Now, in this example, the one with our Sarah Hatcher and Parker O'Reilly with the Must Have Gadgets partnership, they have agreed to share their net income or net loss equally. So when we have a partnership's distribution of net income or net loss, it's usually shown on a separate financial statement. A partnership's financial statement showing net income or net loss distribution is called a distribution of net income statement. Like I said, accountants are not very original in their naming, so it simply shows the distribution of net income for a partnership. Now, our income statements for a partnership are going to be prepared in the exact same way as we did income statements for a proprietorship. They're much more simple than a corporation. And if you need reference for that, that's back in chapter 7 of our book. So with Must Have Gadgets income statement, it shows that they had a net income of $15,725 for the month of July. Now, this net income is used to prepare our distribution of net income statement. So we do have to do our income statement first before we can do our distribution of net income. Our distribution of net income, remember, Sarah and Parker both shared their net income equally. So it's essentially just 50% of the net income for Sarah and 50% for Parker. We do have our normal heading, which is Must Have Gadgets. The statement is the distribution of net income, and again, it is for the month ended, just like our income statements are. We name the two partners, and then we talk about how each partner has, or what percentage that they have received for net income. So it was 50-50, and our total net income then is shown on the last slide. Now, regardless of how earnings are shared, the steps in preparing a distribution of net income statement are the same. The only difference would be that if the partners decided that they did not share things equally, the description of how those earnings are shared may be different. So in another example, Ling Wang and Lucas Fournier are partners, and because of the fact that Wang, spends more time in the business than Fournier does, the partners have agreed in their partnership agreement to share the net income or loss unequally. So in the partnership agreement, it says that Wang gets 70% of the net income and Fournier gets 30%. So what that looks like when we do that is the heading is the exact same. Ling receives 70% of their net income, which was $67,500, and Lucas receives 30%. So that is very possible. Some partners are there more so just for financial backing, and others may be more invested in the business, like Wang is in this one. Now, when it comes to doing our capital and drawing accounts, when we are working with our equity statement, the amount of net income earned obviously is important to our business owners, but the owners are also interested in changes that occur in their owners' equity accounts during the fiscal period. So a financial statement that summarizes those changes is called our owner's equity statement. And what happens here is that business owners can review these to determine if our owner's equity is increasing or decreasing and what happens to be causing that change. So there are three factors that can change owner's equity, and we've talked about all three of these before. Additional investments, more so than what they contributed in the very beginning. Any withdrawals, of course, that are taken out of their accounts, and then, of course, net income or net loss. So an owner's equity statement obviously shows changes about each partner's capital during the fiscal period, and that information needed to prepare comes from our distribution of net income, which we just saw on the previous slides, as well as our general ledger capital and drawing accounts. So the distribution of net income statement shows each partner's share of our net income or a net loss. the three kinds of information that come from our partners' capital and drawing accounts are the beginning amount, and then any additional investments that are made, as well as any withdrawals of assets during that fiscal period. So here's some examples of our capital accounts for Sarah and her drawing account, as well as Parker O'Reilly's capital account, and then the drawing account as well. So remember, these are coming from their general ledger. After they've been posted, of course, they have up-to-date balances for each of those. Now, neither Sarah nor Parker had invested any additional capital during the month of January, as you saw here. They had no additional capital that came in, so just their initial investments. Both partners did withdraw either cash or supplies during the month. And so what we need to do is show some of our changes that occurred during our owner's equity section. So here's an example of must-have gadgets owner's equity statement. What happens for this is we break it down into each partner. So we have Sarah first, and we show her initial capital investment, the share of net income that she received, less her withdrawals, and so that's her net increase in capital, and so her new balance in capital as of the end of the month is $27,412. Then we take Parker's, and we have her initial investment. Remember, that was both the supplies and the cash she added. Her share of the net income, she took a little bit more out of a withdrawal, so her net increase is only $7,112. So that's her capital at the end of the month, and the total then, of course, goes there. So that's what it looks like here for an owner's equity statement for a partnership. And then, of course, there can be situations where we have additional investments and a net loss. So when this happens, for example, we have Marcus Jensen and Emma Johnson. It shows that they made additional investments of $9,600 each, and they also had an income statement that showed a net loss of $4,544, and they split those equally. So we're going to look at their equity statement on the next slide here. So what happens for Marcus is it has their initial capital. They added some additional investments, so we have a total amount that they have put in so far over the month. Then we have their net loss plus their withdrawal. So remember, a loss obviously is coming out. It's not an income, so it's not being added. And we add that then next to the withdrawal, since those are both two items coming out. So they have a net decrease in capital this month. And so we take that 109,000 and take out the 16,000, so their capital is down to 93. And the same thing happens for Emma. She had an additional investment, but she had a net loss and her withdrawals for a net decrease. So we have two capital accounts here, and those two are added together for the total owner's equity. Now, the last financial statement we need to talk about is a balance sheet, and the asset and liability section for a partnership is prepared the same way it is for a proprietorship, so nothing is different there. The only section that's different is our equity section. So with the equity section, it does list the capital accounts of each partner, and those balances of those two accounts are added together, and that's your total owner's equity. And then obviously we take total liabilities and total owner's equity are added together to get our total, just like we've done before. So it doesn't show the asset side of things because that's the same. It doesn't change. But here you can see that we have our two partners. Those are their two capital accounts, that amounts that we found when we did our owner's equity statement. And the two are added together there to get total owner's equity. And then just like before, we take total liabilities plus our total owner's equity to get that total. And that would obviously equal our assets when we're all said and done. So in 23-2, we're going to do some financial statements over in Aplia, so I will meet you over there.